Right, we're here today. My name's Matt McHardy, Head of Investor Relationships at PMG. With me today is Nigel Lowe, the Chief Financial Officer at PMG. It's not very often we roll the CFO out, but great to have you here today with us, Nigel. How are you?
Thanks, Matt. Good to be here.
Good. Hey, I suppose just to set the scene for everybody that is going to be watching this at some stage in the not too distant future, we came through COVID lockdown late March through April, came out of lockdown in sort of May, and there was a whole lot of different industries and sectors that were impacted as a result of us, having to work through that challenging period. Not to mention, probably the retail, hospitality, and tourism scenes that bore the brunt of those challenges really. But commercial landlords in the property sector weren't untouched. And so I suppose, the government had really a requirement to sort of step up and help or assist where they could. And one way that they've done that is through the reinstatement of building depreciation. And that's obviously a benefit in terms of providing some tax relief to offset some of the rental relief provisions that were having to be made by landlords to their tenants. But I suppose, building depreciation and the actual, the tangible link through to the tangible benefit around that is probably misunderstood or not understood at all, by investors. So just to start, Nige, do you want to, I suppose the purpose of this is really to flush out what is building depreciation, how was that a positive thing for our funds and our investors? Do you want to sort of give a high level sort of overview of exactly what building depreciation is?
Yeah, well, I guess, Matt, firstly, depreciation. So we've always been able to claim depreciation on commercial buildings for fit-outs. So it's not the building as such, but always been able to claim depreciation on fit-outs. So it's nothing new to us. But what they did under COVID, but they've extended the depreciation so you can now depreciate buildings. So, for example, any new building you purchase or any existing building, you can claim depreciation 2% on a diminishing value basis. So the effect that this has had on investors is that it has meant that the taxable distribution component of the distribution has been reduced, which basically means more money after tax for investors. So a very, very positive move from the government throughout that COVID phase, and will have real benefits to our PMG investors and our funds.
Great. And so, thanks for that, Nigel. I suppose, and I've seen recently the benefit of that. I mean, my latest generation fund returns netted around 5%. I think it was a fraction under 4.99 something after tax. And there was a clear benefit there from that depreciation piece in terms of the net income I received. And I suppose that's great, but can we give investors any sort of steer roughly on what the benefit may look like sort of into the future? How might that change over time, or how might that benefit sort of exist over time?
Yeah, well, there's been a number of moving parts, Matt. There's definitely been the depreciation that's come through, but we've also seen a reduction in interest rates. We've also seen some tenants receive some rent relief throughout the COVID. So income has been there's been movements up and down on income throughout the year, but overall, to answer your question, there's probably the amount of taxable income has probably been reduced by 20 to 30% on average across the funds.
Yeah, that's huge. That's massive. So you touched on interest rates as well there. Can we just maybe sit on that for a second? Interest rates for depositors out there, it's all very real at the moment. They're at all-time lows, sort of, on call, you're probably at or close to zero. Anything sort of 6 to 12 months, you're about 1.5 to 1.7, 1.8% if you're lucky. And I've run some numbers a couple of weeks ago around the real return after tax and inflation being at or very near zero. But on the mortgage front, the positive story is, our funds tend to hold sort of 35 to 40 value ratios. So we are a borrower of money across the funds. We're probably not seeing the full impact or benefit from those lower interest rates right now because of our sort of hedging strategy or our strategy to fix a portion of our debt for longer periods of time. But assuming interest rates remain lower or at these sort of low levels, what might that look like in terms of profitability for our funds over, say, the next 1, 2, 3, 5 years, assuming interest rates remain where they are?
Yeah, so like you said, Matt, we've got a hedging policy. So we hedge at least 60% of our fund's debt. So we have been able to take advantage of 40% of the debt on a floating rate. So that's moved down to majority of it, probably sub 3%. As the hedge rates come up for renewal, we're going to renew those on lower terms than we're currently paying, provided the interest rate market stays at or near where we currently are. So in terms of a benefit, there's a whole bunch of moving parts. There's obviously new leases being signed up every day. This is just another benefit where the costs have been reduced. So that's again another positive for investors.
Great. Yeah, I ran some numbers after that generation fund, that last return as well. And direct office fund, I think last month was a bit of an anomaly because we had 100% of the distributions were non-taxable. So we wouldn't obviously expect that into the future, would we?
No, in fact, the last three distributions for the office fund have been zero tax. And again, we don't expect that to continue into the future, but I think the next one or two maybe as well.
Great. So I've done some. I mean, you run those numbers as well, Nigel, didn't you? Around what the equivalent deposit rate would need to be to generate a similar net return after tax to investors. What does that look like?
Well, if you're looking at the Gen Fund and 5.8% return, and you're probably going to be paying tax on about 30% of the income, so you're going to need to earn sort of north of 7.2 to 7.5% to get an equivalent return to what you're receiving after tax.
Sure, right. Well, you and I both know, and I'm sure most people around the globe, to be fair, you don't have to be a rocket scientist to figure out or know that it's unlikely we're going to see 7.5% from deposits anytime soon, or other asset classes for that matter.
That's right, Matt. And remember, we're just talking about cash returns here as well. It doesn't take into account the increases in share value over the long term.
Sure. Great. So I suppose just to summarise that, Nigel, thanks for your time. And as I'm sure our viewers, listeners will eventually work out the reason why you and I are talking about this today. As sort of CFO, you've got technical sort of experience and knowledge around the stuff, that an ability to sort of break it down for the average Joe, myself, and some of our clients included in that. But depreciation or building depreciation, the reinstatement of that has been a positive thing for the industry. And a reduction in interest rates over time can only be positive in terms of profitability of the funds, and that's across all funds. All will see the benefit of these two sort of things, won't they?
That's right, man. And probably one other benefit you hadn't touched on as well was the all our funds are PI funds, so the maximum tax rate for any investor is 28 cents in the dollar as opposed to 33 as well. So
true. So
reason.
So deposit, for example, could be taxed at 30 or even 33%. And it's all taxable versus investing in PMG funds, which only sort of a smaller portion is taxable, and the maximum tax rate is actually 28% on that. Exactly. So there's several benefits of course investing in commercial real estate over sort of deposits in that regard.
That's right.
Great. So building depreciation is good. Interest rates moving down is good. High tax strategies or theme or structures is really good. Thanks for clearing up those things for us, Nigel. Is there any other sort of comments around that stuff that you'd like to make, or?
No, I think that's it for me, Matt. There's no saying how long these depreciation rates will stay on buildings. Sure. So I guess just watch this space.
Yeah, sure. Hey, thanks for your time, Nigel, and definitely cleared that up for me, cleared that up for other investors. Short and sweet, real benefits around that stuff, and appreciate you taking some time out of your day to speak with us. Thanks very much.
No worries. Thanks, mate.
Cheers. No worries.